Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, good morning.
Hi, good morning. A little tense this morning. The news flow over the last 24 hours concerning the Middle East. We saw a spike in Brent crude prices eased a bit. But I think the situation is going to bring a little anxiety today. We've seen U.S. markets slip from the highs. And yesterday as well, the Indian markets came off from the session gains.
Well, that's right. The markets got what it wanted in terms of state election verdict. But a quick word on the IPL action as well. Yesterday, Mumbai came out on top and came out on top in style. So I'm feeling good this morning with regard to
It is back.
It's back, and what a scintillating knock that was last night.
Absolutely.
But we've got markets to talk about. So Prashant, let's get straight to that.
Absolutely. And, let's just sort of take it from the top. So oil prices 5% higher. And this is, I think the basic headline, which will matter. So this morning, I think we are off just a little bit. We hit, basically we closed at about 114, soft close 114. And we are, much higher as compared to where we were yesterday. We were $107, $108 or so yesterday while we were trading as 114 now. Now, there is escalation across the board. Iran essentially claimed that it had fired at U.S. Navy ships. U.S. denied claims from Iran that a U.S. ship had been hit. So, of course, that is... this is, of course, all on the back of the U.S. offer. And we talked about this yesterday morning, how... perhaps, President Trump saying that he's getting ships stuck in the Middle East safely out of that strait, the Persian Gulf. He's dubbed it Project Freedom, how this perhaps could be a precursor, a prelude to escalation, military escalation. Iran would not stand for it, and then US would have to retaliate. And we've seen one leg, which is Iran retaliating. We've not seen the other leg, which is the US coming in hard. But that's essentially what markets are worried about. So there is, of course, claims on, as far as Iran is concerned, firing on U.S. Navy ships. There was a drone hit which sparked fire at a large oil hub in UAE. And there was a statement from the UAE government saying that it reserves the right to retaliate in full against Iran for this attack. They're blaming Iran for this attack. South Korea said that one of its ships had been set ablaze off the UAE. Lots of stuff, flare-ups, but escalation overall. U.S. military said, the Central Command said that they've successfully guided 2 U.S.-flagged commercial vehicles through the Strait of Hormuz. There was, of course, this post by President Trump. He kind of sort of stopped short of saying Iran had violated the ceasefire agreement, because if he says, well, they violated the ceasefire agreement, then he'd have to sort of, retaliate and... use force immediately. We don't know what kind of stopped him, but he did warn. And the exact use of phrase was, Iran will be, and I quote, blown off the face of the earth, end of quote, if they attack U.S. vessels which are involved in Project Freedom. So, as I said, we've seen, as expected, Iran retaliate against, U.S. warships trying to make their presence felt and, get ships out of the mouth of the Persian Gulf. But we've not seen the U.S. Come in hard. There was this comment from Iranian foreign minister, which is interesting. He said, as talks are making progress with Pakistan's efforts, the U.S. should be wary of being dragged back into the quagmire by ill-wishers. And I think it's a direct hint at Israel. So should the UAE. So this is from the Iranian side. Just a bit of price action now. Equities were lower, S&P down 0.4, NASDAQ down 0.19. But remember, we've had such a humongous, big, blistering April with gains coming through that this is nothing. They're just small sideway kind of cuts coming through for US especially. The 10-year moved up 7 basis points to 4.4%. Actually, if you look at the 2-year, that also left off just off the 4% level. The 30-year, by the way, the long end, yields closed above 5% for the first time since July last year. So bond markets, of course, are reacting. And as the energy shock becomes more and more, not permanent, but more permanent than before, as there are no real off-ramps which are visible right now, markets, of course, trying to price that in through various instruments. Oil's one. I mean, the rates market is another. Equities, so far, we've not seen very much by way of a shakeout. Anyway, we did, of course, see that initial big sell-off, but that was kind of sort of counterbalanced by everything which is happening in AI, especially for some of the North Asian countries like Taiwan, Korea, etc., which have got lots of these plays. So markets have not. I mean, actually, if anything, if you look at Korea, the Korean market made an all-time high yesterday. But of course, I mean, that's been led by what's happening with the AI names there. I'll just sort of leave you with levels. We left off above 24,100 yesterday. Of course, off the highs, we were up about 300 points in the Nifty, and then things cooled off. At one point, it looked like there'd be nothing left, 10, 15 points on the Nifty, and then, of course, there was a pushback. 24,300 remains the first resistance on the way up. On the downside, 23,820, and then 23,550 are the next two support levels. GIFT Nifty gives you a quick sense of how we're likely to start. Is 100, 120 points lower. And then we will pick it up from there. F&O positioning in the queues. Nigel has walked across the wall. Nigel, take it away.
Well, that's right. Today's weekly expires, so things will get even more volatile towards the end of trade. But yesterday, we did come off the top, and today the GIFT Nifty suggesting a bit of a soft start. And towards the end of trade, you got a sense that the markets were bracing for some kind of, bleakish news overnight, the way we came off from the top. Now, yesterday was a green day, right? But it wasn't a convincing one. I say that because the markets came off the high, and the India VIX as well didn't cool off that much. Even when we were at the high point of the day, we didn't see much cooling off on the India VIX. In terms of institutions, well, they were buyers in trade yesterday, both the FIs as well as the DIs. But you need to note there were a couple of large trades from the FIs. So we'll have to, check out the trend from here on. Yesterday's number could have been skewed because of a couple of large block trades that we did see in there. But a trend from here will be important. The FIs, you don't want them to get back to their big selling ways of $500 million to around $1 billion on a daily basis. So yesterday, no worries. Both of them, they put in the money, and close around 6,000 crores is what you saw in terms of cash market flows. The FIs, well, they added shots yet again. Close around 10,000 contracts is what they added on the short side. That compares with around 2,000 contracts on the long side. So that was in the ratio of around 5:1 in trade yesterday. Well, the FI short positions continue to remain at around 88%. So this market is still net short. And the FIs are not just shorting the market. Well, they're writing calls as well. And in yesterday's trade, they wrote close to around 2 calls for every one put position. So there is a bit of caution coming in from the FIs, particularly in the F&O market. There's a defensive stance that they've taken. But the PCR yesterday as well came down to around 0.75 odd because the call writers were at play in trade yesterday. If you look at the 24,300 call, 24,200 call, remember the markets ended up with a gain of around 120 points, but the premiums on both these two strikes in fact were lower, telling you that the writers believe they have got the higher levels covered. And if you just look at the trend over the last few days, you'll have to say this 24,300, 24,350, that appears to be the resistance zone. I say that because the last few trading sessions, we're going to that mark of around 24,300, 24,350, and we are seeing that level getting resisted. Just in the last 10 trading sessions, take a look at that. We've gone there numerous times, but that level gets resisted. So you want us to get past the 24,350 in the coming days, and then, try to move higher from there on. But for the time being, that's a resistance zone. If you're looking at support, well, the 20 DMA, we'll start closer to that mark in today's trading session. That comes in at around 23,950. So that's the important mark on the downside. You don't want that to get breached by the end of today. But otherwise, the 23,500 mark, that's important to defend because that's where the recent low comes in at. So that band, extremely important on the downside. The Nifty Bank has broken some of those important technical levels, but the stock that I'll be tracking, not just for today, but from here on, is going to be Bandhan Bank. Remember, the stock is trading at a multi-month highs. The management sounded very optimistic about the way ahead. And with, a change of regime in West Bengal and, if, things need to come together, that's one of the stocks that I'll keep an eye on very, very closely. Bandhan Bank, maybe something like what J&K Bank did, a few years ago. We did see a change, out there. And then you had the stock re-rating. Not sure whether that happens, but that's a stock to track going by the volumes and the long build-up as well.
Thank you very much for that. And today what's on tap is the Nifty weekly expiry and numbers from L&T, Hero MotoCorp and M&M. And then you've got a lot of other important numbers like Marico, United Breweries, Coforge, also reporting numbers in the mid-cap space. A big day today in terms of numbers, 3 Nifty companies. But let's talk about, the macros oil prices higher for longer, and what it means for investing. Ben Powell of BlackRock Investment Institute is now joining us in the show. Ben, hi. Morning. I remember chatting with you at the CNBC-TV18 Town Hall. That was a month back, and we began the conversation by asking you whether you think the war is winding down, and your answer was an emphatic no. You said the ground reality is very different from the hot, cold messages that we were getting from Donald Trump. What's your sense now?
Yes. Unfortunately, I guess we were correct in our concern that we're still not on the off-ramp. Of course, it's very encouraging to see tentative negotiations via intermediaries. It's highly complicated, that's for sure. But the reality is we're in, at best, what can be termed a hostile peace. Over the last few weeks, there's been a little bit more emphasis on peace. But the last 24 hours, including, of course, our first missile warnings here in Abu Dhabi, here in the UAE for the last few weeks, has probably been a little bit more on the hostile side. So it's still a very complicated situation. And the bottom line is that energy is still not flowing through the Strait of Hormuz. That's the fact, which is extremely inconvenient for the global economy.
At BlackRock, are you working with the worst case estimates? Because it's not just energy, right? It's fertilizer, it's helium, it's semiconductors. So many things are stuck. Have you all assessed the economic damage and therefore what the investment approach should be? And what could be the off-ramp? How does this end and when does it end, to your mind?
So this is, unfortunately, a classic stagflationary shock. It's the worst of both worlds, slower growth and higher inflation. That puts policymakers in a very tricky spot. What do? Do you cut interest rates because growth is slowing, or do you hike interest rates because inflation is a problem? We think monetary policymakers are going to be wrestling with this, and in the short term, at least, they're going to have to pay significant respect to the inflation dynamics. So that's kind of the macro problem. What's amazing, I guess, Rima, is for global markets, at least we're seeing this extraordinary global supply shock. As you rightly point out, Rima, not just energy, many other kind of critical parts of the global supply chain. So it's clearly a real problem. And yet we are seeing approximately all-time highs in global equity markets, US equity markets, and perhaps even more surprisingly, emerging market equities as well, which is a little bit unusual in the face of such a big economic and geopolitical uncertainty.
Yeah, it's uncertain, but it's like the left tail and right tail, right? Left tail is all this war, etc. On the other side is Ben, hi, morning, is the entire AI thing, the juggernaut which continues to roar on, and that's helping and propping markets up everywhere, at least those markets which have them. And that's been one of the issues with India. People have said, well, it is not lack of AI. Of course, there are other factors, etc. Yesterday, we had somebody who said, well, it's high taxes, why foreigners have stayed away. So just your thoughts, Ben, with regards to India here.
Yeah, look, I don't think India's done anything wrong, if I could put it like this. So I guess if we go back a year and a half, maybe valuations were a little bit lofty. People were too kind of happy. And then we in India, we've been struck by two things. Again, the AI super boom and now the energy kind of problem. On AI, I would observe it is, how can I say, investing into Korea or into Taiwan is a reasonable decision that global investors have made. And frankly, it's worked. So I don't think it was necessarily a bear call on India. It was just a kind of, where can I put my money to earn the best shorter-term return, which is fine. On AI more deeply, what I'm super interested in, Prashant, is if you look at the history of technology, everything from fire through electricity, now through AI, what the story is it starts with excitement around the creator of the technology, which is completely appropriate and fine. But then over time, the technology diffuses through the global economy, and it becomes who can use fire, who can use electricity, who can use the internet. And I think we're going to see exactly the same thing for AI. So for now, we're in the excitement around the kind of creator, which is absolutely fine and normal. But I'm confident over the years ahead, some of that excitement will flow into who can leverage the AI most effectively. And it seems to be India has every chance of being on that list. So that's the challenge for India, for companies, even for individuals, is can we adopt this revolutionary technology and become kind of more efficient, better at our jobs and so forth. And for me, I think India absolutely can.
All right. Hi, Ben. Morning. Good to see you, Ben. What about equity markets? How do you approach it? You know, you've been spot on because you've been holding on to that stance of being overweight US markets and selectively looking at emerging markets. Are you changing that a little bit? Because the US markets have gone one way, though earnings as well are pretty okay out there. Would you stick to the mother market, or do you believe that now you'll allocate more amount of money to emerging markets? And in that sense, India, because of the big underweight, that most FIs have had, and because of the recent underperformance, do you think India comes higher in the pecking order?
Nearly, Nigel, I would say. So look, it's a raging global bull market driven by AI. That's something just like true. So I don't want to miss the big point. This is a remarkable time potentially in human history with the discovery of a new form of intelligence and so forth. So we're fully on board with that. I want to pick up on a word you mentioned in passing there, selective. We are in a world where we're seeing astonishing cross currents. So as we're discussing here, the first part of our conversation, the frightening situation in the Straits of Hormuz, the economic downdraft there, and yet the AI super boom. Both of these are playing out, creating amazing cross currents. And what that means, we think at BlackRock, is this is a time to be more selective and more kind of active in one's approach to investing. I would absolutely bring that lens to bear in India, where I think certain sectors, maybe financials, maybe cement, have got kind of specific opportunities. So I'm on board with the idea there can be, when we see kind of any certainty in the Straits of Hormuz, there'll be, if you like, a global shopping list of things that should recover. India will be on that list, I would have thought. But even in the shorter term, even in the face of the energy problem, there are specific opportunities, more sector-based, even individual security-based. And I think that's kind of the game we're all going to have to play now, not just now, but structurally in the quarters and years ahead, is picking our spots, being more focused on what we really believe at a kind of more micro level, if you like. So that's true today. And I think that's going to persist even when, and it is a when, by the way, even when the Strait of Hormuz situation becomes clearer.
This is that, Ben, what's been doing well, I guess, for the last, almost a year and a half, and it's continuing to do well in 2026, right, is all this new stuff, right? Not new, but data centers and memory and robotics and satellites and rare earths and onshoring and nuclear and defense, and I can go on. It's, those are the themes thematically which have done phenomenally well. And maybe defense, there's a fair bit happening here in India, but many of the other things, industries are still evolving, just picking up. And the government's focus on sort of, building them up. So they perhaps will be those things which will come up over a period of time. Ben, thank you very much for joining us. Good speaking with you. Appreciate your time here. And really good speaking, as always. Thank you. Well, let me just quickly run you through what we have lined up as far as interactions are concerned. So 8:35, we have the management of Quest Corp to talk about their fourth quarter numbers. 9, we have Warren Kevin Harris of Tata Technologies to talk about their fourth quarter earnings. 9:20, you'll hear from Pankaj Tibrewal. He's a market master of the day. 9:30, the management of KEI Industries on their earnings. Coal India will be speaking with us at 9:40. Again, earnings in focus. It's a earnings treadmill non-stop. 9:50, Aarti Industries will talk about their fourth quarter numbers. And we have Jindal Stainless joining in as well. So a fair bit of metals today on the program. Towards the end, it's our special Indianomics segment. After strong April auto sales numbers, Lata speaks with 2 economists and a market research firm to examine if growth may be stronger than market expectation.
Well, time to slip in a short break, but we've got a lot of stock-specific action track for you on the other side in our special Top 10 segment. I give you a sneak peek. We're looking at KEI, Jindal Stainless, Petronet LNG, Shobha, Tata Technologies, Aarti Industries, CAMS, as well as Wockhardt. They'll all be reacting to positive news flow, while you have Manappuram Finance as well as Tata Chemicals that will be reacting to negative news flow.
Welcome back. You're watching Bazaar Morning Call. It's time now to talk stocks. Our research team is standing by this Tuesday morning with CNBC-TV18's list of top stocks for the day. Manappuram Finance will be reacting to numbers. Ananya joins in with more. Ananya?
For Manappuram Finance, the quarter was not entirely clean. The strong gold loan momentum was offset by pressure on margins and core income. Now, consolidated AUM grew 22% quarter-on-quarter and 48% YOY, while PAT surged nearly 70% sequentially, while asset quality improved. Gold loans remain the key driver, with AUM rising 31% quarter-on-quarter and 99% YOY, now contributing around 80% of the overall book. However, on the core operating front, there were clear pressures. Net interest income declined 3% YOY despite strong AUM growth due to a sharp margin compression of 93 bips quarter-on-quarter, mainly driven by aggressive pricing in gold loans. Now, on the cost side, OPEX declined YOY, partially offsetting the NII weakness. Now, encouragingly, Ashirvad Microfinance showed early signs of recovery, turning profitable in Q4 with strong collection efficiency in the new book, although part of the improvement was aided by one-off write-backs. Now, vehicle finance continues to undergo cleanup with a one-time write-off of 136 crore, while MSME stress remains a key monitorable here. Now, looking ahead, management remains cautiously optimistic. They expect continued strong momentum in gold loans, with yield stabilizing around 17 to 18% and borrowing cost remaining benign. Microfinance is expected to stabilize gradually. Now, the company aims to improve return ratios with a medium-term ROE target of around 13 to 16% and over 15% by FY28. So we can see this was not at all a clean quarter for the company. Despite the strong AUM growth, the margins were under pressure.
Interesting one. We'll keep an eye out on that particular stock today. I think there is a Jeffries upgrade that's come in there, but Ananya is saying that, maybe a little bit of a tepid start. Hopping across to Vinny. Vinny, tell us about KEI.
KEI Industries, good set of numbers that's coming from the company above expectations. So revenue saw growth of around 19%, EBITDA growth of around 27%. Margins have seen an improvement of around 70 basis points versus last year as well in Q4 FY26. So EBITDA margins are at 11%. Now, obviously, revenue growth mainly was driven by the wire and cable segment, which saw an 18% growth this time. EPC segment was flattish. SSW segment saw around a 22% growth as well. Institutional cable exports, that seen a decline of 9% on a year-on-year basis. Domestic front, the cable and wire segment, that saw growth of around 13%. Overall value growth is something that's driven the growth, overall revenue growth for the company, given that there were, price pass-throughs that have taken place, higher raw material costs that's come in as a factor as well. Volume growth maybe could be muted, but value growth is what is driving the growth for the company this time, but a good number overall in terms of operational as well as revenue front.
Okay, all right. Thanks a lot for that, Vinny. Well, I'm looking at Jindal Stainless and the numbers look pretty good. And I say that because the revenue came in high by close to around 11%, while you had the operating profit that jumped up more than 35%, telling you that margins expanded to around 12.8% or thereabouts. Now, the numbers look good, particularly in the light that you didn't have any volume growth, actually. The volume's more or less flattish on a year-on-year as well as on a sequential basis. In fact, it's a little bit lower, mildly lower. And despite of that, actually, the EBITDA per ton, which is calculated, that's the number that we're calculating, that's in fact improved. So that's why those numbers look pretty good on a blended, calculated EBITDA per ton basis. The cherry on the cake is the net debt as well has reduced. We'll be speaking to the management earlier, later today at around 10 a.m. So we'll get you an update with regard. But otherwise, Jindal Stainless's numbers look pretty good, more good than bad. Let's go across to Sonal. She's here to tell us about Petronet LNG as well as Shobha. Sonal?
Good morning, Nigel. Let me start with Petronet LNG, where the reported EBITDA looks really strong. Overall revenues were down 15.5%, but EBITDA was up 55%. Margins expanded by 900 basis points, leading to a profit growth of 58% to come at around 1338 crore rupees. Now, this was led by, the revenues were led by higher volumes, but profits were higher due to a reversal of user pay charges that the company had paid back in calendar year 2022 to the tune of 630 crore rupees. Adjusted EBITDA is up 3% sequentially, PAT is up 2% sequentially, but volumes were strong, especially at the Dahej terminal. It was up 6% on a YOY basis. However, they were down 6% on a sequential basis due to Middle East crisis. For Sobha, it was a good set. Their sales value was up 11% in quarter 4, Volumes, however, were down 15%, but on FY26 basis, their values is up 30% and volumes are up 18%. Balance sheet growth has been strong as well, so going with green for both these stocks.
Thank you very much for that. Let me take it forward with Tata Technology. Well, it's a good quarter, particularly a revenue beat. The company's top line went up by 12.5% on a quarter-on-quarter basis. This is ahead of street expectations and the management guidance of 10%. So big revenue beat. And the positive is that organic revenue growth was nearly 7.8%. They did an STech acquisition, which was consolidated 1st of December. So there was a full quarter impact, but that contribution was only about 4-5%. Margins for the company also rebounded to 16% versus 14.1% quarter-on-quarter. The guidance is for double-digit revenue growth next year, and margins further improving to 18% by Q4 of FY27. JP Morgan, though, has a neutral call on Tata Technology because of valuations. They say valuations are at the upper end of the peer set. The stock is currently trading at 30 times FY26 numbers. So that's Tata Tech, but numbers were good. Back to Sonal now for Tata Chemicals and Aarti Industries.
Well, Tata Chemicals, very weak set of numbers. Their realization pressure continues, and that's why the revenues were down 2%, EBITDA was down 16%, margins lower on a YY basis, and the loss was higher at almost 300 crore rupees versus 12 crores on a YY basis. Company said lower soda ash realizations impacted profits, and there was an impairment charge of around 1,837 crore rupees in the US and 182 crores of deferred tax assets which were written off, and that is the reason the loss number was higher, though it was expected to be a loss this quarter already by analysts. For Aarti, it was a strong set. Their revenues were up 9%, EBITDA up 30%, margins were high by 210 basis points, leading to a profit growth of 43%. The company said that they saw volume growth across all the products except for MPDA. However, some of their projects are delayed by 3 to 4 months because they are seeing labor constraints, there are war-related issues as well, and we'll hear the management on air today as well, so we'll get more clarity on this.
Okay, all right. Thanks a lot for that, Sonal. Well, let's go to Devyani. She's here to tell us about CAMS. Devyani?
Well, a steady quarter coming in from CAMS this time around, in line with estimates. Revenue was up 1.3% quarter-on-quarter to 395 crores. EBITDA was up 7.2% to 184 crores. And that's pushed EBITDA margins to roughly around 46.5% this time around. And PAT is coming at 126 crores. The asset mix is important to understand. Management has officially reported that equity AUM has surged to an all-time high of 30.5 lakh crores. And CAMS has captured a dominant 76.3% market share of all equity net sales for the quarter, securing the highest yielding assets that are available in the market. Now, that along with the fact that the operational discipline and AI-led automation has actually helped them with margin expansion. Additionally, the non-mutual fund revenue contribution continues to grow, now making up 15.3% of the total revenue for the company. Now, the underlying metrics are solid, but now what the street will be watching out for is actually how the total expense ratio changes impact the yields going forward for CAMS. All in all, considering the steady quarter with margin expansion, going with a green on CAMS in trade today.
Okay, all right. Thanks a lot for that, Devyani. Going to Ekta, she's here to tell us about Wockhardt. Morning, Ekta.
Morning. Well, it was a good quarter for Wockhardt. Revenue up 30% this quarter. EBITDA up around to 225 odd crores versus around 64 crores on a year-on-year basis. Margins expanded to 23% and profit came in at 166 crores versus a loss on a year-on-year basis and versus 59 crores in terms of profit in the previous quarter. India branded business up 18% year-on-year, UK up 20% on a year-on-year basis in Q4, and the emerging market revenue recorded revenues of 320 odd crores. It's really a very good quarter coming in for Wockhardt.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are KEI Industries, Jindal Stainless, Petronet LNG, Shobha, Tata Tech, Aarti Industries, CAMS, Wockhardt. Stocks with negative news flow are Manappuram Finance, Tata Chemicals. But from equities to commodities, Manisha is now joining in for a complete roundup of the action. Manisha.
Thank you so much for that, Rima. I'll start with the crude oil prices, which we have seen gain by nearly 4% in the overnight market. Slight easing at this point in time, but it really is going to be about the Middle East tensions that have intensified sharply as the US-Iran exchange fire in Strait of Hormuz, with both sides really coming out with various statements on But we do understand that the two American flagships did pass through the strait. The U.S. military also said that they have destroyed 6 Iran small boats, intercepted Iran cruise missiles and drones fired by Tehran as well. There are also reports suggesting that 4 ships in Gulf region in past 24 hours have been attacked, including vessels from South Korea and UAE. So this will continue to keep the crude oil prices much above $100 a barrel. What the street also is watching out for is the US dollar index. That's exactly where you are looking at as a safe haven buying. So with the dollar index on the higher side, most of the metal prices have continued to see a decline. Gold fell 2% overnight. Silver is down 3%. Copper price is now trading at a 3-week lows. Aluminum, zinc also trading nearly 1 to 2.5% on a weaker side. So while the energy markets continue to be firm, it is the metals which continue to take the brunt.
Thank you very much for that. We will get into a break. On the other side, we'll begin Corporate Corner. Quest Corp Management will join in to talk about their Q4 numbers. Stay tuned.
Welcome back. Hope you're having a good morning. For starters, the gift rate is suggesting that we start off a little bit on the back foot. Remember, yesterday as well, we came off the top. So put yesterday's pullback from the top as well as today. We'll be down roughly around 250 points from yesterday's high. But Harmas joins us to tell us about some of the big movers yesterday on good volumes, as well as some of them were backed by delivery. Harmas, morning.
Morning, Nigel. Earnings reactions, most of them, and a positive one at that. First up was BHEL. And not only after the earnings, the stock has run up significantly even before the numbers were announced. But yesterday, the stock went up as much as 12% after the results were announced, then ended around 7% higher. The stock, in fact, has gained in 16 out of the last 18 trading sessions, has a BHEL. On the F&O side, of course, the 390 call option, the premiums were up almost 150% yesterday. The volumes on Monday were the highest since June of 2024. 10.5 crore shares were traded on BHEL yesterday. That's 5x its 20-day average. And a quarter of those shares were marked for delivery. So close to 3 crore shares for delivery, the 20-day average of around 80 lakh shares. And it was the second most traded stock on the Nifty 500 in yesterday's trading session. And over the last 1 month, the stock has gone up by almost 55% and has nearly doubled from its 52-week low as well. The other positive earnings reaction yesterday was Dr. Lal. The stock at one point was in a 20% circuit, ended 15% higher. The biggest single-day gain that the stock has had since its listing in 2015. And in fact, before its results, the stock was down in 5 out of the last 6 trading sessions. Volumes on Monday were the sum total of the last 25 sessions put together. 80 lakh shares were traded. The 20-day average is just 3 lakh shares, and around 15% of those shares were marked for delivery. So around 13 lakh shares for delivery. The 20-day average here too is just over 2 lakh shares. And after that move that you saw on Monday, Dr. Lal has reversed all of the losses of 2026 and has turned positive on a year-to-date basis. And a couple of underperformers from yesterday's session from the Nifty. Kotak Mahindra Bank was an earnings reaction. Bharti Airtel too was down around 3%. Both of them saw delivery volumes of close to 60 to 70% in yesterday's session. And the premiums on the put options yesterday were up anywhere between 20% to as high as 90% for Bharti Airtel. The volumes for Kotak were 7.5 crore shares were traded. The 20-day average is less than 2 crore shares. Bharti Airtel's volumes were around about its 20-day averages. Same for the delivery as well. But for Kotak, 5 crore shares were marked for delivery. That's 70% of the total traded volumes. The 20-day average is just 1.2 crore shares.
Thank you very much for that. Mayuresh Joshi, Director of Research, MarketSmith India, is now joining us on the show. Mayuresh, morning. Thank you for joining us. Manappuram Finance, while the gold loan business of the company is firing, the other businesses, the Ashirvad microfinance business, as Ananya was telling us, is still getting cleaned up. It's a work in progress. It's recovering. NIMs were a bit subdued. What is your assessment of Manappuram Finance's numbers?
Morning, Rima. As far as the gold financing business is concerned, I think it is a very decent set. But again, I think when it probably comes to the NBFC part of the business, which Manappuram has chosen to diversify and probably increase a part of its share in terms of overall revenues and part of the EBIT contribution as well. I think softness continues on that part as well. So I think for a large part of the gold financing universe, I think the numbers should be pretty decent as we exit Q4. So whether it's Manappuram, Muthoot Finance, the core gold financing business should do well. But I think the other NBFC business might continue to be a drag on earnings. There is some hope that microfinance, SME, MSME lending should probably have some element of respite. But again, I think it might be back-ended in my opinion. So I think the other NBFC business might still continue to be a drag in terms of over consolidated numbers.
Okay, Mayuresh, request you to stay on and listen in to the conversation we're going to have with Quess Corp. The company reported a muted set of Q4 numbers. General staffing revenues has seen a decline, but the overseas business is showing some momentum. Lohit Bhatia, CEO of Quess Corp, is now joining in. Lohit, morning, Rima here. Let me begin with the NBFC insourcing, as a result of which there was a big headcount loss in Q4. I believe 7% of the book, 38,000. Was the headcount drag, which is why your general staffing, which is the bulk of your revenue, 85%, reported a revenue decline on a quarter-on-quarter basis. Can you explain what happened with this NBFC insourcing? Does it spill over into Q1? How large a client is it? And are there any other customers where there is that insourcing risk which can hurt?
Good morning. Glad to be on your show, Rima. That event that you're talking about is more than 365 days old. That happened in Q4 of last year. Not this Q4. Just to come back to the results for this year, overall, the company has actually grown this year on 4% on headcount, 6% on revenue year-on-year basis. We've ended the year at 479,000 workforce, of which about 6,000 are working for us globally, 7,000 work for us in the technology and the professional staffing space. If you look at our global markets, they today achieve almost 6% EBITDA margin. Our professional staffing business achieves a 12% EBITDA margin. And our general staffing business, which continues to remain our largest book, also delivers 1.4% margin. To your question on muted growth, maybe for this quarter, as far as general staffing is concerned, there were a lot of global factors, if you really look at it in the fourth quarter, along with some domestic elections, which were quite, aggressive in nature. We found that on the supply side, when elections like this happen, a lot of supply and migrant workforce reduces, which impacted our manufacturing business. However, Quess, over the last 3 years, has had a diversification strategy. Today, exiting Q4 at 2.2% EBITDA margin, our diversification has given us a solid foundation. The PAT for the year has come at 230 crores. Net cash position is 271. The EPS for the year has come at 15.4 rupees per share. And the board, as you must have seen in yesterday's results and announcement, has recommended a 3 rupees special dividend, which has been approved, and 3 rupees final dividend, which is subjected to shareholder approval at the ensuing AGM.
Lohit, apologies. That was my bad about the NBFC bit. But just taking that point forward about margins, now on the back of professional services and that diversified book, your margins have expanded. Now stands at 2.2% EBITDA level. Is there scope to expand margins further?
Again, thank you for that question. At Quess, we've had a North Star that we want to go towards the 2.5% to 3% range in the medium term. And for us, the medium term is the end of this decade. However, getting to that point, we started from a baseline of 1.4%, 1.5%. We wanted to first stabilize the company at 2% margin plus. If you notice, in the last 2 to 3 quarters, we've consistently delivered a margin over 2%. In the fourth quarter, actually, it's 2.2%. And that's again happened because of the back of the growth that our professional staffing with 12% margin book has now contributed 30% to the overall company. And our international book contributes 20% to the margin profile of the company. So we would like to keep it in this range of between 2 to 2.4 for an immediate term, and then guide towards the 2.5 to 3% on the medium to the long term.
Got that. Lohit, hi, good morning. The narrative around sort of Quess or others, right? I mean, not just you, staffing companies, is that, fundamentally, directionally, the number of staff required is less. So staffing as a business is, so that, and we've spoken about this in the past. I mean, just if you want to push back against that, because that's the broader narrative without people not looking into the numbers, etc., and what is actually happening.
So thank you. If you really look at it, I would not push back. I would request everybody to look at the data itself. India sends about 600 million people every day to work. Of the 600 million people, only 20% are in formal work today. How do we define formal work? Formal work is backed up by a contract. It's backed up by financial inclusion. It's backed up by social security. It's backed up by skilling and benefits and over the long-term growth in your own employment, your own career, and your outcomes. That's only 20% of India. While 1 million workforce comes every month to the labor market, 80% still goes into the informal labor market. Everything that India has been doing and the government's structural story towards formality, towards growth, will eventually aid Quest Corp. And you would notice that we are the largest as far as India is concerned by headcount, by number of customers, by revenue, as well as the margin profile, which has come in strongly at 2.2%. I think the structural story for India and embedded story within India is Quest Corp is at least another 18 to 20 years of structural story. So, that's where I would put it. The second point is we work a lot in the technology segment as well. And you know that a lot of GCCs are being created in India. This is because India has the supply of technology talent, which the rest of the world doesn't have today. And for that reason, a lot of transformation work has already started happening in India.
Lohit, if I can ask you, no, I completely agree. And I take that point. So not pushing back, but yeah, look at the data. So just by end segment, end user segment, where are you placing these people? What does it look like now? I mean, which are the end user industries?
So consumer continues to remain, consumer, retail, telecom continues to remain our largest segment. That is followed by, if you really look at it, is the banking industry, closely followed by the manufacturing industry, and then followed by the technology, telecommunications, ITES, the knowledge processing industries. And then we have a long tail of e-commerce and logistics, public enterprises and services. There are also new green shoots which are coming out, and Quest Corp has worked aggressively in the last 1 to 2 years. Some of those I'd like to mention briefly. One, obviously, is construction. While construction today gives us less than 3,000 people, the kind of margin profile that we are getting on construction, it's part of our press release as well. It's over 8% EBITDA margin. It still falls under our general staffing space. And that's a business that we are very bullish about because India has about 5 crore workers in the construction segment, with 99% of them are informal workers.
How are you making more margins on construction jobs, Lohit?
So, the skill enablement in construction enables us to get better per day realizations, both from the supply side as well as the demand side. Even today, majority of the clients that we work with have a demand which is almost 2x of the supply that we are able to give.
This is a shortage of skilled labor in construction. That's essentially the point.
That's right.
Okay.
That's right.
And you got about 3,000 people on it, right? My only thing, and the reason why I asked that, how are you able to, and maybe that answer, what you said answers it, but across industries, I mean, so the big job generators, right? IT services, we speak with all large companies. Hiring is looking down, not up. GCCs perhaps is the only exception. And you already alluded to it, banking. I mean, it's the sector is doing well, but it's not hiring gangbusters. Telecom, So I'm just saying, your realizations will depend on whether you're placing well-paying jobs, staffing well-paying jobs, or at the lower end, right? And are we really saying that well-paying jobs are exploding on the upside?
I wouldn't put it that way. What I would say is that if you look at the professional services business of ours as well, you will realize there are 3 broad constituents. Our biggest book of 71% actually comes from GCCs. Our second biggest book at about 20% comes from IT services to enterprise customers, which could be banks, e-commerce companies, retail companies, manufacturing companies, design companies. It's the smallest book, which is at 10 to 11%, comes from IT services companies. As a staffing company, we pivoted ourselves towards the GCCs and less towards the IT services way back about 5 years ago. And that has aided the kind of growth and the niche segments that we operate in.
And GCCs, all the big guys are already here, right? I mean, the biggest, everyone is here. Now, of course, it's a smaller, more niche operations which are coming in that sense. Would you agree? Lohit?
India has close to about 2,000 GCCs, but two-third of those GCCs have come only from one country, which is the North Americas. We still don't have enough GCCs which have come in as Generation 1 companies from Europe or from Middle East or from Far East. What we have to also look at is, like you rightly said, a lot of Fortune 500 companies are already here. But the companies between the $5 billion to $15 billion revenue size, which actually require more of India's support to take their work to the back office, actually is the one which is going to give growth in the next 4 to 5 years. These could be nano, or these could be micro, or these could be small GCCs. And that's exactly the space in which Quess operates.
All right. So you're saying within what you define as IT, 70% is GCCs, right? IT services itself is only 11-12%, I think you said, right? The rest is services to enterprise.
Yeah.
Okay, fair enough. A good conversation. Lohit, thank you very much for joining us. Appreciate your time here, and thank you for being here on CNBC TV18. Quess Corp Management on numbers, but of course the bigger conversation, I think, which is the dominating driver from a share price perspective as well. 212 on Quess. We'll take a break. We're back. Mayuresh is going to be with us. Mitesh also with us. Sudarshan Sukhani. So technical trading ideas with Mitesh and Sudarshan in just a bit. Okay, welcome back. So lots of action with regards to individual movers, even as the market this morning will open slightly on the downside. I think Kempro, which is Kempro was, I'm just looking at it now, it was the number one volume traded, volume-led gainer yesterday, was up 14%. Now this is ITD Cementation. Formerly known as ITD Cementation. The Adani Group took it over. So it's an Adani Group company. And, we were talking about elections and whether there are individual stocks perhaps which are movers. It's basically, by the way, based out of Kolkata. ITD was based out of Kolkata. From 680, it's moved to 950, 960 yesterday in 2 sessions flat. So it's a massive move, which we've seen in the last 2 trading sessions or so. I mean, the thing with this company is that most of the projects, etc., which Adani does on the civil side, construction side, perhaps comes to this. At least that's the hope, that's the expectation. Last year was good. 2025 was a consequential year for this company, and this year is turning out to be already pretty good. It's up 20% for the year so far. Just any thoughts on this one, Mayuresh, if you track it?
Morning, Prashant. I think they delivered a solid set. So for the quarter gone by, I think the revenues were up quite significantly. The EBITDA margins were close to 15%, which is one of the highest in the recent quarters. And that is obviously getting backed up, as you rightfully pointed out, Prashant, in terms of a very solid order book, which stays at 24,800 crores. And that's very well spread out against maritime projects, in terms of urban infrastructure, in terms of industrial, and in terms of data centers, etc. as well. And therefore, I think on a consolidated basis, for the annualized number as well, a 20% EBITDA margin is reasonably decent. The expectations in terms of solid growth expected to come through is something that can still play out on numbers very, very positively in the next few quarters.
Lal Pathlabs was another massive mover yesterday. Actually, yesterday was a big day for a lot of stuff. Lal Pathlabs was up 14. RR Kabil was up 14. Idea Forge, it's a bombed out name. It's the right space, defense and drones in particular. Idea Forge, there was an IIFL equities initiation yesterday morning. And the stock was limit up 20% yesterday, 731. There were others as well. Loris was up 6. And by the way, we had managements of Dr. Lal and Loris, etc., with us on the show yesterday. On Idea Forge, Mayuresh, any thoughts?
I think this is it, Prashant. And again, I think this entire thesis in terms of escalation that you're probably seeing in the Middle East is prompting a lot of economies to probably go for drone and drone technology, which has probably become the most pivotal aspect in terms of the entire flashpoint as far as use of technology is concerned. Now, a decent set of numbers, but I think the entire thesis that the market is probably looking forward is more adoption that probably happens both in terms of drone, anti-drone systems, etc., And I think that is why I think the markets have taken numbers and the expectation in terms of more orders coming their way, whether it's domestically driven or export driven. Making a base case scenario of order book probably improving over the next few quarters with relatively better margins, probably leading us to believe, or leading the markets to believe, that earnings probably might remain very, very stable in a very volatile environment, at least for the next few.
Mayuresh, KEI Industries reported numbers, and we'll have the management on the show now. But prima facie looks good. Q4 revenues at 19%. For the full year, the company's growth was 21%, so slightly ahead of the guidance of 20% that they'd laid out. Your assessment? And in the cables and wires business, yesterday, RR Kabel did well. We had Havells numbers already out. How would they compare with KEI, and which one would you pick?
Rima, I think decent set of numbers by KEI Industries. I think a good set, in fact. And again, I think if you probably just compare what RR Kabel also probably did in terms of their earnings delivery, it was again a very solid set. RR Kabel has a very small component in terms of the FMEG part of the business as well, which accounts for 10%. But a large bulk of the revenues comes in from the cables and wires business, where at least on an exit at Q4, I think the EBIT margins for wires and cables were relatively higher compared to the overall business, obviously, because FMEG business has a relatively lesser EBIT margins. However, I think with the kind of supply chain issues that can probably crop up in Q1 numbers, whether it's KEI, whether it's Havells, whether it's RR Kabel, and the kind of jump up that we've probably seen in copper prices, what kind of inventory level do they hold on to is something to be watched out for in the management calls. I've not heard the call so far, but I'd probably read through that as well. And the second aspect in terms of both supply chain and the ability to pass this through completely, and what kind of an effect does that have on demand dynamics. So exit Q4 numbers are very, very good, whether it's KEI or RR Kabel. However, I think how Q1 will play out, and if this continues for a longer period of time in terms of supply chain issues, etc., how does that play out in the first half numbers? And whether that has some element of, say, in terms of overall annualized numbers as far as the FY27 is concerned, is something to be watched out.
All right. Hi, Mayuresh. Good morning. Good to see you in. Mayuresh, I wanted your word on the cement industry. I'll tell you what. Q4 was good. It could have been much better if it wasn't for this, war that broke out, because Jan and February were good. But still, Q4 was pretty okay. Now, the problem is that Q1 as well, we may not see that much of an impact with regard to input costs going up, but Q2 is going to be a big hit. 200, 250 rupees as well is what you're factoring in terms of a EBITDA per ton hit. Now, the other news is that overnight, you had Ambuja Cements that had their con call. And they hinted to analysts as well that, they may not go very aggressive in terms of volumes, in terms of expansion. Now they'll focus on profitability. I believe that there was a site visit a couple of months ago, and at that time they indicated. Now they've laid it out even in the con call that aggression is something that will be put on the back burner and profitability will be at the forefront. How do you read this for the cement industry on the whole? That could mean, better profitability. Because when they came into the system, they were pushing a lot of volumes, which was depressing prices and then in turn profitability. So what's your top pick from the cement pack?
Morning, Nigel. I think the industry is clearly moving towards a phase of organized consolidation, if I have to put it that way. And therefore, I think with additions that are expected to happen, both in terms of organic growth as well as mergers and acquisitions that are probably happening for the industry as a whole, you're probably going to see the top 4 or 5 players actually having a larger share in terms of both pan-India operations, as well as expectations in terms of how the capex is probably expected to play out. Interestingly, I think if you probably look at ITD Cementation, which is Sam India's slide that they probably put out in terms of their earnings presentation, I think the capex slide is very, very interesting that they probably put out, both in terms of housing, infrastructure, railways, etc., expected to go up significantly. And therefore, from a volume growth perspective, over the next few quarters, on a structural basis for the industry as a whole, it is expected to grow at a very, very decent pace. Add to that, the consolidation that is probably happening within the industry will probably mean that pricing probably remains far more intact compared to what it was a few years back. And therefore, I think with intermittent issues that probably come up, and it will obviously show up in terms of input costs going higher as we report Q1 or even Q2 numbers, which is traditionally a soft number because of monsoons, etc. I think structurally, I think we are probably heading to a scenario where profitability is going to probably take a front seat. And with a lot of operations, specifically the energy consumption that is probably happening at their captive use as well, along with mines, which are probably coming up as well, the profitability of the industry on an EBITDA per ton basis should probably go higher. So I think structurally remain positive. We stay with leaders, actually, stocks like Ultratech or JK.
Ultratech and JK, got it.
All right, Myresh, stay on. We need to slip into a very short break. We'll come back with the pre-opening. We'll also connect with Warren Kevin Harris of Tata Technologies to talk about their Q4 earnings. Stay tuned.
Welcome back. Well, we're almost getting into market open, so let's welcome our technical experts. We have Mitesh Thakkar as well as Sudarshan Sukhani who join us on the show. Good morning, gentlemen. The markets yesterday celebrated a thumping victory and, good outcome, what the market was anticipating. And now the focus is going to be on what kind of reforms can we see, since we're going to have 10 months of a clean slate, no state elections, and hopefully some of these states as well that otherwise have been drifting towards populism start seeing some kind of economic activity. That said, on the technicals, how are you seeing things, Mitesh? Yesterday, we again went to around 24,300. That level got rejected, and now we are starting off on the back foot with a cut of 150 points. Buy the dip or wait buy?
Morning. So, I have maintained that the Nifty might do a range of about 23,800 to about 24,350, 400. That's what's been playing out for the last few days. Ideally, I would be looking to buy the dip, but there's one worry, which is clearly visible on the charts, is the negative traction on the charts of Bank Nifty. So it's the banking stocks and the banking index which is slightly turning negative, and therefore that could put Nifty under pressure. So if I am to attempt a long on Nifty, it has to be very close to about 23,850, 800 zones, and then you can take a 80, 90 point kind of a stop loss and go long. But for the timing, I think the immediate 120 point kind of a gap will not interest me to buy.
Yeah. So you'd buy a bigger gap, Mitesh. That's what you're saying. A bigger gap down.
That's right.
Got that. Sudarshan, morning. What would you do?
Yeah, good morning. Well, the idea is that the Nifty has done a test of 23,800 last week and successfully did it. Now we'll see choppy market action, but so far as that level holds, 23,800, I would be a buyer on a dip. So today's 150 point dip or 120 point dip is actually a buying opportunity for me. My stops are tight, but yesterday I explained, I'm repeating, these are positional trades, not intraday trades. The idea is that sooner or later, the Nifty will see a very decent rally. So we have to be positioned for that. If 23,800 breaks on the downside, we exit, wait patiently for new levels to form, but still only as a buyer.
Yeah. Got that. Now, what would your trades be, Sudarshan? Individual, stock specific?
Well, delivery is a buy with a stop under 460. The stock has been making a pattern of higher highs, higher lows. Lupin has been in a trading range for almost 10 weeks now, and that was after a big up move. I'm assuming the breakout will be on the upside. Buy Lupin with a stop under 2,300. NTPC is a short with a stop above 405, and IRFC is a short with a stop above 110.
Mitesh, what about you? What are your picks?
I have a mix of buys and sells, and as I mentioned earlier, Prashant, the selling calls are on the banking names. So Bank of Baroda is a sell with a stop just about 270 for a target of 255. Similarly, Indian Bank is a sell with a stop at 846, half 847. And traders can look for targets of 795. On the buying side is Britannia, buy with a stop at 57.50 for targets of 58.80. And Lupin for me is a conditional buy. It's been hovering around this level of 23.55, 23.60. And a breakout above this 2360, 2362 range would call for a long position with a stop at 23.39 and a target of 24.10.
Okay, gentlemen, we'll come back to you for more trades at 9:10. For now, let's invite the management of Tata Technology. Reported a strong showing on the top line. The company's revenue growth at 12.5% was ahead of expectations. Kevin Harris, the CEO of the company, now joins it. Kevin, congratulations. I remember 3 months back when we chatted, you had guided for a revenue growth of 10% in Q4, and you've done better. You've delivered that and more with 12.4%. How much of it is on account of the Estec contribution? That's the acquisition that you did, and how much was organic?
Yeah, I can certainly break up the first quarter performance. Of the 12.5%, about 4% of that was EzTech. The rest was organic growth that we posted. And the encouraging thing from our side, not only did we deliver against what we had said we were going to do, the improvement was broad-based. It was not just within the anchor accounts. It was across both the automotive, IHM, and aerospace accounts. And we also had very strong performance from our education business. So, all of our lines of service and all of our industry verticals were firing. And it was our expectation that really reinforced the guidance that we provided, not just for Q4, but for fiscal year 27. We are not only confident of double-digit growth, we're confident of kind of consistent performance across the quarters, and our deal signings in the last 3.5 months are the best we've ever seen. So, we couldn't be more bullish about the prospects that we've positioned for ourselves in the new fiscal year.
Well, that's good to hear. The deal signings in the last 3.5 months are the best ever, and you're confident of a double-digit organic revenue growth next year. Let's talk about margins. Margins expanded 190 basis points to 16% quarter on quarter. What led to it, and how much more by way of margin expansion from here on?
I think we will continue to apply all of the operating levers, but as volume improves, as scale returns to the business, you'll start to see us get back to where we were 18 months to 2 years ago. And the guidance that we provided at the beginning of this calendar year is to get back to a run rate of somewhere north of 18% in the fourth quarter of this year. And that's certainly something that we stand by.
Well, that's 200 basis points and margin expansion from Q4 to Q4. 16% becomes 18% plus by Q4 FY27. Kevin, what about the long-term guidance, the aspiration, the North Star in terms of revenues and margins?
Well, the long-term guidance, our North Star is that we are committed to becoming a billion-dollar company in the next couple of years. And so the growth rates that informed our progress after the pandemic and before the slowdown 18 months ago is something that we expect to return to. I think with scale will come incremental improvement in operating margins. Our North Star has always been 20-21%. We remain committed to those numbers and those targets. But I think what we're also excited about is just the nature of the opportunity that we're driving. And I think this is one of the reasons that our bounce back is somewhat counter to what we're seeing across the rest of the market. I think our ability to be able to take on turnkey product responsibility, complete vehicle responsibility, complete work package responsibility is giving us a seat at the table with our strategic customers. We're influencing their decisions, and therefore our performance has been predictable in the recent short term, and we expect that to continue going forward. So again, we see market conditions improving. We see Tata Technologies leveraging that to steal a lead on the rest of the engineering services market here in India, and that should be something that we can further scale from as we continue to close deals this fiscal year and beyond.
Well, thank you for laying out that long-term ambition, $1 billion in terms of revenues, 20-21% margins. Whenever we've spoken in the past couple of months now, you've highlighted how automotive OEM decision-making remains uncertain. There were tariffs, German auto weakness, there was JLR restructuring, softness there. Are all those headwinds behind us? Because you've clocked in a very strong quarter. How sustainable is it? And what are the risks ahead of us?
Well, I don't think all of those headwinds are behind us. I think the challenge in the Middle East, I think one of the things that is not yet talked about is the impact that that's likely to have on the commodity market and things like aluminium and plastics are likely to be impacted going forward, which will represent further headwinds, not just for the automotive market, but also for the industrial heavy machinery market. But I think, one of the things that I've said constantly is that automotive, construction equipment, off-road, on-road commercial trucks, those businesses are product-led businesses. And after companies have not invested for a couple of years, they have to get back to investing in new products. And that's what we are seeing after the new normal was established after the tariff announcements. And I think we have been the beneficiary of that, not just in Q4, but in terms of the deals that we've signed in the first month of this fiscal year. And it's those things that are really informing our confidence and our expectations for the foreseeable future.
So auto is doing well, but what about non-auto? While aerospace is also actually pretty okay, the overall non-auto business is about 19% of your services. What would it look like 4 or 8 quarters down the line?
I think if we were to look out in 12 months' time, I think that the growth of aerospace will continue. I think commercial truck will continue. But what we're seeing at the moment is a bow wave of automotive opportunity. And so, if I look 12 months from now, I'm not sure that we will make too much in the way of incremental improvement from a percentage perspective, simply because we're tapping into investments that have not been made in automotive for the last 2 years. So I think medium to long term, we're likely to trend towards 70% automotive contribution, 30% contribution from non-automotive. But it's going to take 2 to 3 years for us to get there.
Thank you very much for joining in. It's 9:10, time to get back to our technical call. Sudarshan and Mitesh are back with us. Sudarshan?
Buy delivery with a stop under 460.
Mitesh, yours?
I'll go with the sell on bank on Indian bank. That's the call here.
Buy delivery, sell Indian bank. Pre-opening rates are coming in and it's down about 66 points. We're getting limited cues from the Asian markets, Japan, China, Hong Kong and South Korean markets. 4 of the key Asian emerging markets are shut today. So therefore, we could see a little bit of muted activity. But back to tracking stocks. BHEL was a big mover yesterday. Good numbers. Volumes were very large. Vinny now joins in to make a bull and bear case argument on BHEL.
Hi, morning. So first up, BHEL, yesterday we had the numbers. They reported the numbers. The stock saw a run-up of almost 12% intraday, a new 52-week high that came in for the stock as well. And then it started seeing a cool-off. Now today, obviously, what are the brokerages saying about this as well? CLSA, they're maintaining the underperform rating. Target price they've given is 282 rupees per share. What they're highlighting is that BHEL, yes, turned quite positive in terms of the top line. That was good. Margins also was driven by this good top line that came in. But the quality of the growth, they highlight that that's not good. Gross margins fell 150 basis point. Obviously, and the expansion that came in on the EBITDA margin front also included some cash provisions as well as forex gains. So what they're highlighting is that BHEL has already rallied a lot in the last 1 year. If you look at it, it's almost 60%. And that's on the back of the energy security theme, which is phasing out now in the past few months as well. It's become more expensive, so they do not find value in BHEL as of now. Now, JP Morgan too, they're maintaining the underweight rating. Target price is 220 rupees per share. They're similarly highlighting that the sharp outperformance, which is coming in the stock price already in the last 1 year, is a good exit point and an opportunity to exit the stock given the deeply cyclical names, especially given the thermal power plant theme that's coming off as well. So obviously, because of that, when you look at it, they believe BHEL's FY25-26 profitability has actually was boosted by those provision write-backs that came in and forex gain. So now if that goes off, maybe it will come off as well. And obviously, the outperformance that we've seen in the stock versus the Nifty and other companies as well is a reason to make that exit coming in. Energy storage systems, that's seeing a rise. Solar, that's seeing a rise. And that because of that, coal-based projects, that's power generation projects, they'll be coming off as well. So they're not too positive on this one. Let's move on and talk about some of the bull cases now. We have Morgan Stanley maintaining their overweight rating, raised the target price to 444 rupees. They said that overall the macro positioning of the stock is improving in India. They believe BHIL turnaround could continue and surprise the markets going forward as well. There were a lot of surprises that came in Q4 as a positive surprise, but they expect that strong operating cash flow, that will be a key driver for the company, and the improved revenue execution, consistent power segment margins, as well as increase in market share are the factors that could lead for a better performance for BHIL going forward as well. So that's the bull case.
And Vinny, from anything from Morgan on forward looking? I mean, what are they expecting from here? More ordering? Because as you said, JP Morgan is saying, well, bulk of the large ordering is behind.
So they believe that actually the receivables, the order book is not that bad. There's a bit of a decline that's come in this time, but they still have order book that is strong. So they believe that that will be something that is still giving a revenue visibility. So that's why they believe that there will be improvement in the receivable positions going forward as well, and cash flow conversion. That's also going to see a better improvement. So that's what they've highlighted so far as well.
Okay, all right. Big run up and opposing views, 380 on BHEL. But some of the points which JP Morgan makes with regards to energy storage systems, battery storage systems, basically, it's going to be a big one. Solar versus coal, in terms of how electricity is produced. You need both, but how do you balance both? As solar comes up in a big way, and it's an interesting debate at that. Well, we'll just quickly run through some of the stocks that we will address stocks straight away. There's about 8 seconds and counting down to the market open. You've got the sensex, which is down about a quarter, the nifty, which is down about a quarter, bank nifty and the small cap indices all starting is largely flat to sideways, basically. So about 1/3% down on the nifty, 23,993. The nifty bank is down about 0. Nifty bank is starting slightly, down 0.6, 54,400, 54,500. The mid-cap index is down about 1/3, and the small-cap index is coming up with about a 0.13% of a cut as well. Small caps, of course, last week and the month of April have had it very, very good, and that continues to be an area of strength for the market. 140 points lower on the Nifty, 23,988. If you can just quickly put up the Nifty 50 heat map, we'll give you a sense of where we start. ONGC is up as oil is up. Tata Consumer, Adani Ports, Cipla, ITC, Dr. Reddy's are some of the others. Adani Ports is a big high-quality buyer, as Nimesh had highlighted in his D Street chatter. Adani Ports is high on the back of it, I guess. Shriram Finance, Indigo, Bajaj Finance, and Asian Paints are some of the others, which are starting on the other side of the spectrum. But it's a 100-point cut, down 0.4%. Rima.
Well, the big drag is coming in from the IT stocks. The Nifty IT index is open with a cut of 1% this morning, with names across the board. HCL Tech is lower in trade. Pull up TCS, Infosys, weak. So IT is under pressure. Along with that, the banking names. The Nifty banking index is down 0.5% in line with the frontline indices, but HDFC Bank is the big culprit here, and ICICI Bank too, selling off about 3/4 of a percentage point. Pull up some of the others like Axis Bank as well. But on the way up, you've got Realty Index doing well. The Nifty Realty Index, I think the last time I checked, was higher in trade. Okay, now it's slipped into the red. Metal Index will also come up. Pharma is holding up. In terms of stocks on the way down, Shriram Finance, Bajaj Finance, auto names are weak in trade. Maruti Suzuki, Hero MotoCorp, M&M. These two come out with numbers later today. Oil marketing companies on the back foot, BPCL, HPCL 1% lower. L&T ahead of the numbers is selling off nearly 1%. On the way up, not too many gainers, but Adani Ports is your top mover. Reliance Industries is now seeing buying, so continuing with the rally that started post numbers, up about 0.5%, and now IT names are pulling back. Opened up in the red, but now TCS and Infosys, Wipro are back in the green. Mixed picture, but a little more subdued, given the rise in crude prices, and the advanced decline ratio has now flipped in favor of the gaining side.
Well, the next few interactions you'll definitely want to tune into with regard to managements, because you have KEI Industries actually that's down close to around 5%. Morgan Stanley, they've downgraded the stock to equal weight. The target price, though, they've raised to around 5,200. They point out that the stock has outperformed big time in comparison to what the Sensex has done over the past 6 months. So those are one of the reasons. So that stock is under pressure. We'll hear the management in just a short bit from now. Aarti Industries as well. That stock has opened up with a bit of a cut in today's trading session. I think we should get that one up for you on the screen. Aarti Industries down close to around 3%. That company is due in the next 30 minutes or so. The other one is Jindal Stainless. The numbers look pretty okay, actually. No operating leverage played out, but yet the EBITDA per ton improving. The share is a little bit skittish with regard to the input costs going up, and they'll want to know what kind of volume guidance can the management give us. We'll have that at 10 a.m. itself. Other stocks that are doing pretty well, Vocart, that's one of the stocks of the morning. Big uptake is what you're seeing out there. Shoba, the other stock that's flying away. So a couple of big winners is what we have on the list today. And Sterlite Technology is what a stock it's been moving from strength to strength today as well. It's up close to around 4.5%. Yesterday it was up close to around 5%. Sunflag, that's the other stock that we are tracking. Mr. Bansali yesterday went ahead and bought a large chunk in the company. And it seems the street has got quite excited. Remember, you had Lloyd Metal that's seen a big re-rating from around 1,100 rupees to around 1,800 rupees. But Sunflag, well, it hasn't moved. And remember, they have 10% stake in Lloyd Metal. But what will they do with that stake? Will there be any kind of value unlocking? You know, the promoter intent is something that has been tracked over the last few years, and they haven't done much in terms of Sunflag. But for the time being, large investor buying a stake, the street likes it. So the stock is up close to around 10%. It has valuation comfort. Idea Forge, one of those bombed out names. Stock has bounced back yesterday, and today it's bouncing back in style yet again. So good move is what you're seeing on Idea Forge. So net, the advanced decline ratio is more or less even Stevens. The Nifty is down close to around 60 points, but we are seeing some kind of buying at lower levels, which is heartening. And Reliance Industries, that's the one that's holding one end up. The problem is the Indian rupee has dipped yet again. 95.4, we can't go on at this sort of a pace. You need some stability. You need some pullback from these levels.
Okay, well, 24,000 odd on the Nifty. So basically, we've got about a little over 24,100, and now we're back around the 24,000 levels once again. Pankaj Tibriwal is with us. He's founder and CIO, Ikigai Asset Managers. Pankaj, good morning. Good to have you with us here. Thanks for joining in. You've been constructive, and you said, well, perhaps the worst is behind. Some of the stuff which is happening is completely outside the control of what companies can do, how efficiently they can run their businesses, and what they can do to mitigate, right? I mean, one is energy, cost of energy feeding through everything. And the longer this stays at a very high level, the longer perhaps damage, even at good businesses, well-run businesses, Pankaj. So how do you kind of sort of weigh it off against what you're seeing, which is this, some amount of positivity which was starting to creep in, which perhaps on the other side is being pushed back against by the cost of very high energy prices?
So good morning, Prashant. A very relevant question in current times. I think our sweet spot now is about $85 to $90 of crude. And anything above that probably will be a pain point from an overall macro perspective. And obviously, it will flow down to company-specific and sector-specific problems. Obviously, nobody knows when the West Asian crisis gets resolved. But our sense is that the reason we were positive in the end of March and said that it's the time to go all in was that 18 months of time and price correction had happened over the broader markets. Valuations were looking attractive. Sentiments were at the lowest point we could ever see in the last 2.5 years. And obviously, nobody saw April coming, and April is the best month for broader markets, especially mid and small caps in the last 20 years. The way we look at things is that the world before 28th of Feb and after 28th of Feb will be two different worlds. The last decade was determined by disinflation or lack of inflation. And the next foreseeable future, we believe that inflation will be the core theme because of the underinvestment which has gone into the energy sector or metals and mining, and the disruptions which we are seeing will not let inflation come down. And hence your portfolio construction and the companies which will do well could be very different from what we have seen in the last decade or so. Hence our belief is that own leaders of the sector, because what we have seen in the past that whenever inflation comes in, the smaller players give away market share to the leaders of the sector. And we are seeing across home improvement, we are seeing across tiles, plywood, PVC pipes, you name any sector where there is a large unorganized portion sitting out. The reason is that in a high inflationary situation, the companies find it difficult from a working capital credit perspective, raw material volatility, they don't have the balance sheet and cash flow. And intuitively this time around, in the last few conference calls, we are hearing the same commentary coming out of management, that they gain extra market share in this disruption. And this is just the start, in my view. This disruption is not going to end overnight. And hence, companies which are leaders in the sector will gain. Also, Prashant, don't forget, this is after 12 quarters in a row that India Inc. will see top-line growth in double digit. What India Inc. delivered over the last 12 quarters was margin expansion. But now the top-line growth has started to come in, and our belief is that 12 to 13% top-line growth can't be ruled out, and which brings in operating leverage, even if there is some dilution on the gross margin. And let me give you some data on the earnings which have spanned out. Till a couple of days back, out of the NSE 500 company, 109 companies have reported, and almost equally between large caps, mid caps, and small caps. Large caps have delivered about 8.5% earnings growth. Mid caps have delivered about 50% plus earnings growth, and small caps have delivered about 27 to 28% earnings growth. So last quarter results are spanning out quite nicely. However, this quarter, in our view, it could be a little slower quarter because new raw material cost will get into the system. There will be a lead lag between the raw material cost and how much you can pass on to the end consumer. And April has started slow across many industries in terms of demand because a lot of dealer distributors are worried because of the volatility that they don't get stuck on the wrong side. So maybe first quarter could be a little slow quarter, but I think inflationary situation helps the leaders of the sector to perform better and gain market share over a period. And hence our focus is bottom up. I think this will be a clear market trend that if you can pick up companies which are gaining market share, which can grow their earnings in this environment, I think your portfolio should do well. And our preference lies in the sectors which we can discuss at a later point of time.
So your view is that we are in a high inflationary environment, and therefore we should see market share gains for the larger players, the more organized and the larger companies. So this would be across which sectors? Because we have unorganized a sector in specialty chemicals, auto ancillary, your paints, pipes, cements, tiles, laminates, jewelry. Which sectors would you back to play this theme?
Across the board, if you look at, for example, the home building, the moment Morbi was shut down, the pan-India players who have outside Morbi plants, they gained market share in the month of March, and it continues in April as well because the disruption is still there. The same voice has been echoed in the wood panel space. So the couple of con calls which happened on the wood panel space, the managements were clear that the leaders are gaining market share at the expense of unorganized. And wherever you find that there's a large unorganized sitting, there has been a huge raw material inflation. Trust me not, the leaders will benefit out of it. In a disinflationary situation, normally the competition mushrooms across regional places, and which creates a headwind for the leaders to grow. And the opposite happens the situation we are in, where the supply chains are stretched, labor is an issue right now, and hence people who have a good balance sheet cash flows will gain disproportionately. And that's what we are seeing. So it will span across sectors. In chemicals, a very interesting thing is happening, that over the last 3 years, if you speak to any chemical company, the biggest pain point was China. The Chinese imports were happening at a price which was lower than the cost of production of Indian players. 3 things have happened post that. One, yuan has appreciated almost by 20% versus rupee. The second is the logistic costs have doubled from China to India. There is supply chain disruption across. And the fourth thing is that Chinese government has removed export rebates from 1st of April. And we believe that a good cycle is starting for most of the chemical companies. And we may be in a new cycle for chemical. Also, the top line growth will be in double digits because they are all derivatives of oil, most of the raw materials, and hence they have been able to pass on to the end consumer. And margins, there could be some dilution, but coming to EBITDA margins, I think there could be operating leverage, which could kick in, and hence earnings growth of this sector, which has been subdued for last 3-4 years now, probably starts to look into double digits. So that will be my dark horse for this year. Last year, we spoke in January, February, dark horse was commodity. It still continues. Now it's a consensus call. But from here on, I think the dark horse could be energy. It could be chemicals. It could be power-related themes. all of them which probably could outperform over the next 12 to 18 months.
Okay, all right. Hi, Pankaj. Good morning. Always good to see you in. And I remember that call on, commodities that you spoke about. Also, some of those pipe makers like Welspun Corp. You were talking about it, I think, at around 800 odd rupees. And that's done quite well. But I'll get back to those sectors and themes in just a bit. I wanted to ask you about the biggest skew that we got yesterday, which is the state election outcomes. You're a numbers man. I'm sure you have done some kind of number crunching on that. How positive is it for the economy on the whole? And in terms of a market perspective as well, suddenly you have one part of India that's not seen a lot of development. Maybe growth as well has been relatively low, and per capita income as well has been relatively lower. Now, there's going to be a lot of focus on West Bengal. Have you put any numbers together? If you could give us a sense in terms of GDP impact, in terms of company-wise impact, something on those lines.
So good, Nigel. I come from Calcutta. That's my hometown, as you know.
So I ask you.
Coincidentally, over the weekend, I was in Kolkata and I attended a social function where all the industrialists and companies out of Calcutta were there. And there was a unanimous optimism. And mind you, over the weekend, the votes were not still counted. So nobody knew the results, but everybody was optimistic that BJP is coming with 180, 200 seats. And they were looking this change with a lot of expectation and optimism. I believe it's a very, very welcome change. For 34 years, the left was there, then 15 years, Trinamool was there. And just to put numbers in perspective, West Bengal has been the lowest growing state in terms of per capita over the last century in India. Among the states, it's West Bengal which has seen the lowest growth, led by many other things, which we don't want to get into details. And if you go into the past, Nigel, I don't know whether you are aware, in the 1750s and 1800s, Murshida was the richest place on the planet. And from there to the times of glory, which Bengal has seen to where we are, it's a state of disappointment. But this state has everything. Cheap labor, cheap power, port, fertile land, you name it. For any industry to grow there, it's a dream come true. And I believe that this is a very welcome change. People want development in Bengal. People want industrialization in Bengal. And people want the per capita income to grow. So the growth of Bengal could definitely add incremental GDP to the overall country, the way it happened in Bihar, if you remember, the way it happened in Jharkhand, and the way it is happening in UP. I can only tell you with our experience when we speak to companies, the kind of positive feedback we are getting for the administration out there in UP is just unbelievable, that how a leader there can change the entire circumstance of law and order, industrialization. Companies based out of South India who have never ventured into North, they have gone into UP and have full praise about that state in terms of law and administration, the way they were assisted in terms of setting up businesses. So I think that same template can be replicated in Bengal, and we would be surprised at the growth which this state can deliver. And there was a glory in the 1700s, 1800s, and Kolkata was the capital of British Raj. And then since then, we have seen a downfall over the last century. We are hopeful. The entire community in Bengal is hopeful that this change could bring in development. And overall, it's nice. Now, 21 states, either in form of direct or alliances, are ruled by BJP in terms of their governments, which is a welcome step that they can have a pan-India policy and things can be implemented at a faster pace. The next election is in March, April in UP. That's a big one. So you have a window for reforms, which I think if
Pankaj,
goes after, we could be surprised.
Absolutely. Apologies, sorry, but point well taken, Pankaj. And thank you very much for joining us. We are on the earnings treadmill, you would understand. We've got management's waiting back to back in that sense. I think the management of KEI Industries is with us, and let's just go across to them for a quick chat. We have Anil Gupta, CMD. Mr. Gupta, good to have you with us here. Thanks very much for joining us. So I just wanted volume numbers from you first up, because I think growth is strong, price-led, but what has been volume growth in the quarter compared to the same time last year and quarter on quarter?
Good morning, Prashant. The growth, volume growth in the quarter is around 12.5%. Actually, some revenue was, export revenue was hit because of the non-dispatch of manufactured materials due to Middle East crisis, and shipments were not leaving to the Middle East, which is our potential export market. So that led to some fall in the revenue in March, and otherwise we could have grown by another 2% in this quarter.
Oh, volume growth is how much, sir? You said
around 12.5%.
12.5%. This is in the quarter that we are in. How is that trending so far?
No, it's very positive. It is very strong. In this quarter, also in April, we have seen a very strong momentum, and there will be a strong growth in the first quarter also.
You know, we've spoken about prices, very high prices impinging on volume growth, and you've said in the past that at very high price levels, maybe there is some curtailment in off-take demand, etc. Is that showing up at all or no?
No, I don't see any change in the demand pattern because of the high prices. So buyers can, at maximum, defer the purchase decisions by 10-15 days. But since their projects are ongoing, their timelines are critical, they can't delay the purchase.
So you said there was a loss of 2% on your top line on account of shipments which are stuck, dispatches which could not go through to the Middle East, which is an important export destination. And this happened in Q4 where there was a 1-month impact. Now, the Middle East crisis is still playing out. What is your expectation on exports for the current quarter?
Exports will be positive because our export destinations are spread all over the world. It is only the Middle East where it is impacted. But now the only way is that we have dispatched a lot of cables to Middle East in April by absorbing very high freight. Because now the materials are going to some Fujairah port, and from there by land route they are going to different destinations in Abu Dhabi and other Qatar, etc. So it is moving, but we are sharing the increased freight cost with the buyers, and some we are absorbing.
Okay. So what could be the potential volume growth in exports in Q1, and what is the impact of the cost increase that you've had to take?
No. I mean, since export forms just 17-18% of our total turnover, the impact on the overall margins will be very, very small. And so far as export growth is concerned, actually it will be in line with, I'm sure that it will be more than 20%, but we have not yet quantified it because we will still have to figure out that how the Middle East crises are impacting. Some decision making in Middle East has slowed down because of the non-availability of people in the offices, and but decisions are being taken, and we have still received substantial orders from Middle East even in April as well.
And for FY27, sir, you stick to the 20% revenue growth guidance that you pretty much maintained as medium term. And since you will get some additional production from Sanand in Q4, will volume growth in FY27 be better than FY26? And what's the number that we're looking at?
We are confident that our revenue growth in FY27 will be 20% and more. And it will be purely led by production from Sanand, because all our other plants are already producing at the highest, their peak capacities. So that is why our volume growth was lower in the last financial year. But we are confident that our growth will be very substantial in FY27 because of the commissioning of Sanand facility.
All right, Mr. Gupta, just to reconfirm this, cables and wires, you're saying the growth was 12.5% on volumes for the past quarter on year-on-year basis. Is that correct?
Yeah, correct.
That would mean that value growth was only around 7 to 8%?
Yes.
Okay, all right. Just reconfirming that, because a couple of sales notes, in fact, were working with far lower numbers, but you're giving us that volume number. We have taken note of that. Let's focus on margins. Margins for the past quarter were around 11%, which is the best since Q4 FY24. And on your core wires and cables business, the EBIT margin stood at around 12.4%, which is the highest since Q2 FY21. Give us a guidance on both these two aspects, because input costs have gone up, though you have taken some price increases as well. So what's the broad band we work with?
See, I have always maintained that our EBITDA margin in FY27 could be anywhere between 10.5 to 11%. I am always conservative in projecting our EBIT margin, and we always strive to improve it during the course of execution in a quarter. But I am confident that whatever we are projecting, we are going to do better than that. But it is impossible for anyone to absolutely predict the margin percentages.
Yeah. But this input prices, I mean, that's just, and we've discussed this before, this is pass-through for you, right? I mean, it's just simply pass-through.
Absolutely. It is simply pass-through. And you have seen, I mean, in our 15 years of history, we have now seen several, price cycles, and our margins have not gone down.
Yeah. Just one last quick bit on competition. Is competitive intensity same, higher, lower? Have we spoken about this in the past?
See, competition intensity is same and higher as well. But we have our own market. We have our own customer base, and I think that is growing even in India as well as abroad because of our good execution.
That is not going to lead to lower margins, higher competitive intensity. I mean, that is the only kind of consequence in that sense.
Not at all.
Okay.
So your order book declined on a quarter-on-quarter basis. Any particular reason for that?
Because we have not booked any EPC order during the year, and you know that our EPC sale is declining as a policy of the company. So and so far as cable orders are concerned, more than 55% is the dealer sale, where the orders are not taken into consideration while giving this figure. Rest are project orders. So then there are only that much orders, and those are executed maximum within 3 months.
Okay. All right, Mr. Gupta, we wish you and the team all the very best for FY27. We'll keep chatting periodically as the year progresses. Thanks a lot for joining in.
Thank you very much.
Well, let's move to Coal India then. That's the next management on our show. It reported a mixed set of numbers to discuss what's the past quarter and what's the way ahead. We're joined by Coal India's chairman, Mr. B. Sairam, as well as we have the company's Director of Finance, Mr. Mukesh Agarwal, who joins us on the show. Hi, gentlemen. Thanks a lot for joining in. Well, Mr. Sairam, let me come across to you first. You've got off to actually a softer start in April 2026 on the volumes. That's despite such strong power demand. Tell us, what are the production dispatch targets that you have for FY27?
Actually, what happened that in the month of April, normally it happens that we take up overall of our machines and plants. So that is what exactly happened in the month of April. But May onwards, we are very much hopeful that the production as well as the offtake quantities will definitely pick up. And this year, the production target which has been assigned to us is 815 million ton. And this target is based on the historical averages as well as the projected demand from power sector as well as non-power sector. So 815 million ton production will be there. And then we are sitting on a comfortable stock of 130 million ton as on 1st of April. Last month, we could moderate it to the level of 122 million ton. So this production program as well as the stock gives us a lot of operational buffer to meet the growing demand. And demand is naturally going up. Last year, 240 gigawatt the peak capacity. This year, in the month of April itself, the peak demand had risen to the level of 243 gigawatt. And the analysts say that it will go up to the level of 270 gigawatt. So means there is a need to up our sleeves, and we are braced for the whatever demand comes up from the power sector. Yeah, that is our take on this. And with all these things, we will be landing at a closing stock of 95 million ton. So there will be a 6% growth in production. There will be dispatch growth of 10% in the likely scenario, and there will be closing stock for maybe 20 to 27% reduction.
Okay, a soft start to the year, but you're optimistic that things pick up from here on. Got that. We're going to hold you to these numbers. Let's focus on a couple of aspects then. What will be the dispatch growth for the e-auction segment? And also, if you could help us out with e-auction premiums. It's not increasing despite global prices moving up. Indonesia as well is likely to export less. What's the trajectory on e-auction realizations?
The e-auction depends on two things. One is the demand, which is a natural thing. And second is how the prices across the globe move up or down. So last year, the demand was less. So that was a factor which was responsible for subdued premium. And second, global pricing was also more or less stable, at least for the first 8-9 months. In the last quarter and in this financial year, the dynamics of global coal demand as well as global supply chain is taking a lot of dynamic reactions and actions. So we are hopeful that there will be an increase in the notified price in this year. Last year, the notified price increase, the premium was 38%. We can expect a 4 to 5% additional premium this year.
Correct. All right, Mr. Mukesh, let's get you in then. What is the increase in the cost of production? Since you mentioned that the cost of explosives as well as industrial diesel, both of them have spiked up from March onwards. Also, why are you not passing it on?
We had given that we are insulating the prices of the increased diesel and the explosive. On the other hand, the Coal India always believe on the volume growth. Volume growth, as the CMD sir has told, we are planning 815 million tons against the last year 716.8. There will be 6 to 7% growth in the volume. And the second factor will be the natural attrition of the manpower. These two factors will help to offset the current level of increase in the diesel prices and the explosive, so that our EBITDA will remain at the constant level of the 32 to 33%. These two drivers we are using.
All right, Mr. Mukesh, can you quantify the point you make on attrition? How many employees will superannuate in the coming year?
We are expecting some around 9,000 to 10,000 non-executive will superannuated in the natural course. This will help us to rationalize the increased cost of the diesel and the explosive.
Okay, all right. So there's already been a dip and you're saying another 9 to 10,000 employees will superannuate. Got that. Mr. Mukesh, what is the capex plan this year and how much will be non-coal based business contribute, say in revenue terms, in the coming year, since there's a lot of focus on that as well?
Actually, last year we had done a capex of 16,000 crore. And if we see that we had planned a 1 lakh crore capex down the next 5 years. So it works out around 16 to 20,000, 25,000 crore in the progressively in the coming years. So out of 1,00,000 crore, we had planned 66,000 crore towards the gasification project, 15 to 20,000 crore rupees towards the renewable energy, 10,000 crore rupees is towards the thermal energy, and some acquisition which we are planning for our critical mineral and other resources. So these are the capex, and we see that after 5 to 10 years, after 5 years, around 10% non-coal business revenue will be there in our top line.
Okay, 10% of the total mix coming from non-coal business. We'll have to track that number. Also, what supports Coal India in terms of valuations is cash in the books. Mr. Mukesh, what's the update on that? What is the current cash in books?
As on 31st March, it was around 51,000 crore rupees cash was available. But these cash are going to be, because basically we have two companies where the more cash are there. There is the NCL and the MCL. In NCL, we had already taken a big project of Singrauli Visthapan, where a lot of land is required. So these cash are going to be added utilized in the coming expansion project. And similarly, MCL has also taken up the 2-3 new projects where this cash is going to be utilized. Otherwise, other subsidiaries are maintaining a normal level of the cash. But considering the huge requirement of big ticket size projects in the NCL and NCL, cash are there.
Having cash in books is good, sir. But what about dividend payouts? That's been quite healthy over the last few years. Could you tell us what is the guidance on that front?
Last year, in 24-25, we had given 26 rupees 50 paisa. And the 25-26 also, we had given the 26.50. But the payout percentage has increased from 46 to 52% in this financial year. And we will strike a balance between the capex requirement and the dividend in the coming year, as we are doing previously also.
Okay, all right. Well, before we let you all gentlemen go, Mr. Sairam, I'm coming across to you. There's a lot of talk of there is some shortage of coal stocks in India. Would you like to clarify? Because you're the biggest coal miner in the country. What's your stance on it?
Yeah, absolutely not. Absolutely not. This is my one-word comment on this. Because the thermal power plants and they are maintaining a stock of 50 million ton. On 1st of April, it was 55 million ton. It has come down to the level of 51 million ton rather. And we hope that with all the coal sector production ramping up, we will be able to maintain the coal stock in this range itself. Add to this, we at the Coal India pithead plant, our mines pithead, we are maintaining a stock of 122 million ton. Add to this, there is an in situ coal exposure to the level of 48 million ton. So all these things gives us a lot of comfort, not the level of comfort, but the operational flexibility that we can ramp up the supply whenever demand spike takes place.
We take your point, Mr. Sairam, as well as Mr. Mukesh. Thanks a lot for joining in. Wishing you all the best. We're going to hold you all to these numbers. 815 million tons of total volumes is what you're guiding for, with margins in the band of around 32 to around 33%. Thanks a lot for joining in and clarifying there is no shortage of coal. Enough adequate stock is what is there. Thanks for joining in. Well, we'll slip into a short break. You come back, we'll connect with the management of Aarti Industries to discuss the past quarter's numbers.
Welcome back. Let's continue with Corporate Radar. Aarti Industries is in focus. Strong set of numbers, revenue margins coming in healthy. In fact, volume growth was witnessed across all key products. Suyog Kotecha, CEO and Executive Director of Aarti Industries, is now joining in. Suyog, hi. Morning. This is Rima here. You know, we were just chatting with Pankaj Tibrewal of Ikigai Asset Managers, and he was talking broadly about the chemicals industry. He said the industry struggled for the last couple of years on account of dumping from China, but that is changing now. He said yuan is appreciated nearly 20%, logistics costs have gone up, and Chinese government has stopped export rebates from 1st of April. Is this something that you are seeing on the ground, and what will be the implication for Aarti Industries?
So it's definitely something that's visible on the ground. I think it changes from value chain to value chain, but in select value chain where Chinese government has taken a stance related to anti-involution, where they are taking several measures in terms of removing subsidies like VAT subsidies or restricting exports. Those value chains have started to see pricing and margin conduct improving in those value chains, especially for Aarti Industries. You know, nitrochlorobenzene is such value chain where we have seen significant shift in terms of Chinese behavior, in terms of their export product placement, and that has had impact on the global pricing as well as the volume flows.
Suyog, hi, good morning. Talk to us a little bit about the current situation. Is raw material sourcing a problem, Suyog, because of what is happening in the Middle East? And, if across the chemistries that you operate in, where is it an issue? Where is it a problem?
Yeah. No, so I think West Asia war is, of course, a major event for the industry in general and for us. And I think it has sort of impact in multiple ways. From a direct impact point of view, we do have roughly 10% of revenue coming from Middle East, which, of course, we have to figure out alternate market till the time the situation stabilizes in the Middle East. That's kind of direct impact. On the raw material front, frankly, we have well-diversified supplier source. So availability is not a major challenge, though we have to, figure out a spot purchase given some of the contractual suppliers from Middle East have declared force majeure. But availability, we are still able to figure out. It comes at a significantly escalated pricing, given the way crude and the other raw materials have moved in the last 6 to 8 weeks. But availability in general, we have been able to figure out. I think the impact that we have to watch out for is, how much it is going to cause damage in terms of medium to long term. We think the price rise overall will lead to a kind of an inflationary scenario globally, which could potentially have impact on the global demand. And as a 55 to 60% export-oriented organization, it could have an impact in a 3 to 6 months time frame. As far as the near term is concerned, raw material, we've mitigated the impact to some extent by diversifying our supplier sources. And in terms of product placement, the effort continues to diversify away, at least for the near term, till that situation stabilizes in Middle Eastern markets.
Is the cost shock? As you said, you had to buy on spot. So what is the? Give us some sense. What are you buying at now compared to pre-28th of Feb?
No, look, I think the raw material escalations have been phenomenal. And forget spot versus contract, because even contracts moves with the index. In general, any of our large raw materials, if you look at it, benzene, aniline, toluene, the price escalations have anywhere in the range of 40 to 60%. That's the kind of price escalation that we have seen. In most of the cases, we are pushing very aggressively to pass on these price rises to customer. And I think everyone is understanding the situation, given it's a global phenomena. But there will be certain lag. There will be certain contracts that we will have to also honor from our mid to long term commitment kind of stuff. But it's a significant increase compared to mid-Feb kind of scenario, right? Anywhere between 40 to 60% is a kind of increase in the raw material cost.
Right. And you, as you said, you're pushing hard to try and pass on this, right? I mean, but it's not possible in all cases.
Yeah, I think there will be always, different applications will move differently. I think some applications, usually, the bulk chemicals, the passing on the price happens relatively quickly. I think more specialty, more, contractual customer, where sometimes the pricing formulas are quarter average or 6-month average. There it does take time to pass on the price rise. So it will be a mixed impact at some point in time. If the scenario continues like this, then of course, over a course of 3 to 6 months, the price rise will be passed on. But it depends on how soon the situation stabilizes in the Middle East.
Yeah. Just one more thing. One is, price increases. The other is availability itself. Has availability been an issue in some chemistries, in some of these value chains for you? Inputs?
No, I think at a certain price point, frankly, everything is available, right? So by and large, for us,
I'll be specific. Like, for example, sulfuric acid, right? I think China imposed some curbs.
Yes. So we are a producer of sulfuric acid, and we buy sulfur domestically. And yes, the price rise have been quite phenomenal, but we have been able to secure our requirement from our availability standpoint.
And these 10% exports to Middle East, has it stopped? Or are you able to divert the supply? Has that impacted your growth? And for FY27, what are you penciling in, volume and value growth?
Yeah, no, I think so. The export to Middle East have significantly reduced from 1st of March onwards. We are, of course, trying to secure alternate markets for these products. Again, it does take a little bit of time to diversify away and place those kind of volumes to alternate geographies. I think we've had partial success, and we continue to remain on track to figure out alternate markets for many of these products. I think for the year, I think we've given the midterm guidance. We continue to remain sort of focused on delivering that. There will be near-term volatility. I think quarter on quarter, given the scale of the event happening in the Middle East, I think there will be some impact. But I think we are not deviating from where we want to reach in a 2 to 3 year time frame. That's the guidance that we had given. I think what's important to understand is, while we focus on the near term, it's also important that we continue to deliver on our long-term aspirations. And we did close, 2 long-term contracts in the last quarter. One of which was a repeat contract with a global major for a 15-year term with relatively secured earnings. The second one was a $150 million contract over a 4-year time frame. So I think what's important is, while we navigate the near-term challenges, I think we continue to execute our long-term agenda to give, high-quality portfolio growth from a midterm standpoint.
Yeah, no, absolutely. Are there any labor shortages? Any projects which were about to start where they're not able to start because of all of these issues?
It is. I think it's an indirect impact of West Asia war, because I think the commercial LPG issue did see a significant impact in terms of contract labor availability in the region where our capex projects are getting executed. We are roughly 30-35% short on the contract labor right now as we speak, compared to where we were 1 quarter back. And that has led to a kind of a 3 to 4 month delay in terms of our capex project execution. But we are actively mitigating it, including figuring out how do we give assurance to contract labor in terms of no impact being caused because of the commercial LPG issue. But yes, it does have an impact on the project execution timelines for us.
Yeah. Yeah. So just leave us with a guidance, Suyog. Is it possible to leave us with something?
Look, I think we talked about, three fronts, and we have been consistent in the story for now last 4 or 5 quarters, right? I think we have cost angle of 150 to 200 crores. We have operating leverage of 350 to 550 crore, and then we have capex-led growth for the remaining portion to achieve our midterm guidance. I think on all the cost initiatives, we are frankly mostly done. I think all of them are implemented. They should start accruing fully from the coming year. I think on operating leverage related issues in terms of our volume and the capacity ramp-ups, we are very much on the track. I think whatever we said, we are executing it and it's happening as per the timelines. Apart from, near-term volatilities like, West Asia war, but I think from a mid to long-term point of view, all of them sort of kind of remain on track. I think it's the capex-led growth where we have had 3 to 4 months of delay. Though all of these projects will get commissioned within the FY27 timeframe, I think compared to our expectation, today we see a roughly 3 to 4 months delay to sort of commission and commercialize this asset. So I think we are not changing anything at this point in time, while we remain watchful of some of the latest developments and figuring out way to mitigate the impact from a midterm standpoint.
Okay, good conversation, Suyog. Thank you very much for joining us. Good speaking with you, and good luck as you navigate through some of this over the next many months, hopefully not quarters, and things resolve and get better. Thank you. Well, I think commodities are what we are sticking with in that sense, and it all, of course, all this chemistry and products, etc., flows from oil, crude oil, and that's what Manisha is focusing on. She's here with what's top of mind. Manisha, over to you.
Thank you for that, Prashant. Well, absolutely. There are two sets of fundamentals to talk about. One on why the crude prices ran up and why we're looking at a bit of a profit-taking in the Asian markets right now. One, first of all, is the price movement. The implied volatility continues to be very, very high. We saw 6% of gains in the markets at one point in time. We closed 4% on the higher side. On a weekly basis, we've seen 8% of gains come in for the crude oil prices, and that totals up to nearly 85% of gains till time in 2026. Well, the latest crux really comes in from the Strait of Hormuz itself, where we have seen West Asia tensions intensify as US and Iran exchange fire in Strait of Hormuz. The US Central Command says that 2 American flagged ships passed through the strait, but this is because of the effort that the US military is putting in there. The US military also said that they have destroyed 6 Iranian small boats, intercepted cruise missiles and drones as well coming in from Iran there. There have been also reports that Iran has attacked 4 ships in Gulf in the past 24 hours, including vessels from South Korea and UAE as well. And then you have statements from the UAE media also reporting interception of Iranian missiles and fire at its Fujairah oil terminal there. These are the reasons that you saw the crude oil prices surge up. Now take a look at the reactions from some of the biggest ones that happen in case of crude. Chevron's CEO yesterday has said that the physical oil storage appears to be shortening or declining around the world therein. He also continues to say that it is about commercial markets, whether it is about shadow feeds and national strategic reserves. All of that seems to be getting absorbed into the international markets right now. Goldman Sachs, in the meanwhile, said that the global oil stocks are approaching the lowest level in 8 years. Goldman Sachs goes on to say in its report that the global oil stocks are at 101 days of demand and could fall to 98 days by May end if this status quo continues till the end of the month as well. Barclays, in the meanwhile, has increased its oil average forecast in sense of prices to 110 by the end of the month of May. Now, the reason that you have seen that 1.5% decline coming for the markets is that every data suggests that there is some increase in supplies coming in from the non-conventional areas. So when you look at the US oil and rig numbers, that has continued to increase for a second straight week. You also have the Venezuela oil exports gaining up by 14% for the month of April. This is the highest in 7 years. You also have seen OPEC Plus increase production for a third straight time in a meeting there by 188,000 barrels per day. This would start kicking in from the month of June. And then we do understand that the Strait of Hormuz is mostly shut and 17 to 20 million barrels per day is getting lost. But there is pipeline capacity ramping up happening from Saudi Arabia to UAE, We do understand that both of these countries together are via pipelines putting out nearly 7 million barrels per day of a crude oil there. That is what the street seems to be looking at. And then it also is about IEA, which says that the global oil demand austerity measures that have been taken by the governments also will start impacting the sense that you wouldn't need that much of a crude. So 0.8 million barrels per day of a contraction in this year is what perhaps we could be looking at. And then this is something that most analysts have been arguing, that earlier oil supply shocks, and this one is different because right now we are less energy intensive versus the previous oil shocks. So whether it comes to electricity, renewables, we are working with all of that direction as well. So it is lesser and is the reason that you haven't seen prices sustain above 120.
All right, Manisha, thank you very much for that. We'll see where we head from here, but hopefully lower. Otherwise, I mean, it's problematic. As you can see, the dollar rupee is at the bottom of the screen, and it's at a new high. The dollar, that is, and the rupee is at a new low this morning. We'll take a break. Metals and focus, commodities very much has been the theme throughout. Jindal Stainless Management joins in to talk about their fourth quarter performance and outlook. Stay tuned, coming up.
Welcome back. Well, let's focus on Jindal Stainless. They reported actually a good showing in Q4. Operating profit was up close to around 37%, though the volumes are more or less flattish because there were some constraints due to gas availability. To discuss this and what's the outlook ahead, we're joined by Tarun Kumar Kulbe, the CEO and CFO of Jindal Stainless. Hi, Mr. Kulbe. Good morning. Good to see you, and always a pleasure, sir, to catch up. Let's understand a couple of aspects. First, on the gas availability. Globally, there's been a lot of uncertainty that's been at play. And because of that, gas availability has become an issue, not for you, for the entire industry. But for your company, how is the gas availability situation? And are you all using now alternate resources to fire your plants?
Thanks, Nigel. Well, on the gas availability front, we have to see, Nigel, that in our different plants, while predominantly we use propane and LPG as a fuel, but in our Mundra plant, we use natural gas. Now, when the Gulf crisis started, on the natural gas also initially there were restrictions, but availability of LPG and propane became immediately a problem. Gradually, I will say the situation has improved, but the cost what we paid multiplied. I'll say 3 to 4 times. The cost went up on the LPG prices for the obvious reasons that the availability was a constraint. Now, going forward, we are now working because natural gas availability and price stability is better. So even in our Jatpur plant, in our Odisha plant, we are working to increase the usage of the natural gas. Mundra plant availability is already better. Availability of LPG and propane also now better, I will say, but the prices remains high.
Okay, all right. Availability is good, but the input cost is still high. Okay, Mr. Kulbe, let's get 2 big numbers that the street will be waiting by for. One is on the volume growth. For last year, you were guiding, I think, in the vicinity of 8 to 10%. You've ended up with around 8%. So what kind of volume growth are you targeting for FY27? What will exports contribute as a percentage of the mix? Because that, I recall, used to be in low teens. That's come down to 5-7% or thereabouts. So what kind of contribution will you get from there? And point number 3 is blended EBITDA per ton. 19 to 21,000 rupees is what you were guiding for. Last quarter, you did around 21,000 rupees. So for this year, what will it be? Volumes, exports, as well as EBITDA per ton. Go ahead, sir.
Okay. So on volume front, Nigel, we had guided 9 to 10%, and we were on course to deliver whatever we had guided, that volume increase for FY26. Unfortunately, the March month, we faced the sudden disruption in our operations, due to which we ended up attaining 8.1% volume growth in FY26. Now, for this FY27, we are targeting again a volume growth of 7 to 9% for the whole year. But and we are expecting not so much of disruption here onwards. So far as the market, our export market is concerned, we in our Q3, our export share of the total volume had come down to 5%, which is back to 8%. And for the FY26 also, our export has been 8% of the total volume. Now for FY27, Nigel, export markets, I will say, if not very booming, then stable. We are able to sell in the markets like Americas and all, where in the near past we have not seen much of disruptions. All in all, we are targeting around 8 to 10% of export share in our total increased guidance, whatever I have provided to you.
All right. And EBITDA per ton?
EBITDA per ton, right now, we will provide the guidance only for H1 because, as already I stated, that due to this war, a lot of uncertainties are there. And the cost also, as I said, the fuel prices are very high. We hope that gradually the normalization should come. Looking at all this for H1 only, right now I'm providing guidance that is 18 to 20,000. We are just watching it. Maybe after H1 or we will review the whole thing and then we'll provide you the revised numbers.
Very quickly, sir, there was a notification that came with regard to imports that look like it's making imports relatively easier, because they have relaxed some quality controls. Is that a big risk for your business? Do you see that, or was it something on expected lines? And also quickly, if you could comment on your net debt. Just a 20-second answer, sir.
Okay. So on the import front, this is basically the QCO removal, what we are discussing. This means that the government has allowed the import of substandard quality product, which earlier was restricted. So we don't see this as a positive move for the industry because this definitely will allow particularly substandard material coming from China, mainly, and of course Vietnam also, it was getting routed through before. So we don't see as a positive move because within the country a good capacity is available and we should be encouraging the good quality product usage into the various end products where it has been removed. So far as our net debt is concerned, we have ended up at 3040 crores, whereas our guidance was 35 to 3700 crores for FY27. So far as guidance is concerned, we would like to further reduce it, and we are targeting anything around 26 to 2800 crores.
Appreciate you joining in, Mr. Kolbe. Always a pleasure talking to you. We've got the broad numbers out, a quick but effective chat. Looking forward to chatting out with you soon, and maybe in fact we could have an interaction once you announce your Maharashtra capex plans as well, which the street is waiting for. Thanks a lot for joining in. Well, time to slip into a short break, but on the other side, our special Indianomics segment. After strong April auto sales numbers, Lata speaks to two economists and a market research firm to examine if growth may be stronger than market expectation. Stay tuned for that conversation.